asked to speak after Tosin. And Tosin says the bar very high. So wherever there's conflict between what I'm saying and what Tosin has said, Tosin supersedes. All right. And then, of course, for the fact that I'm talking to a room of lawyers, that's both a plus and a minus because, well, we know ourselves, so that's the plus. But I happen to be one of the outliers in the profession. So when they say lawyers don't like numbers, money is a number. So even if you don't like numbers, at least like money. Yeah, I found my love for numbers inside money. You cannot just be calculating math up and down. The math has to have a purpose. So this is math with a purpose. All right, so I'm going to simplify everything as much as possible so that everyone can follow along. So a few ground rules. Please put your phones on silent. We have a working fine. I usually have a working fine. It's income. You have to come up with creative ways to generate income. So please, if your phone is going to ring, you can just make a down payment of 1,000 now so that will allow you, then we can use the remaining for the money that we generate for whatever purpose. I think there are breaks provided, there are conveniences, so we can continue. So who am I and why am I teaching? Like I said, I'm a legal practitioner, but I've had quite an interesting personal career history. Academically, well, I pursued a postgraduate diploma in business administration immediately after law school. I also did a personal course in corporate finance, and I did a self-study of investing. So my knowledge of investing is not per se from a formal organization, because if you've ever tried to learn stock market investing, you find out that very few places teach it. So you really have to want to know it. So my work experience, well, interestingly enough, I have an old colleague in the room right now, and I'm very privileged to be in the room with her, as in the person of Auntie Kemi. So we work in the same office, but well, I worked there very briefly, and due to prevailing circumstances, I relocated to a different part of the country and I engaged in entrepreneurship. So I wanted to set up a business, to set up a farm, right? Delta State, and we had the farm running, and we grew it, got some funding, and we did a lot of good work there until, well, Forex and other things happened. So outside of that, I worked in my practice. While I was in Delta State, I worked with Chief T.G. Okoko, SAN. I think that should be familiar to him. And I think the bulk of my experience from Okoko's office, I moved over to Qualitative SAN. And so while I had my farm. Now, after that, I moved back to Lagos, and I was invited by an asset management firm that had been monitoring my business while I was in Delta State. So on relocating back to Lagos, I was consulting for them before I went in-house and I became a project manager. So I was a project manager while I was in a venture capital firm. So being around finance, being around numbers, that was real encouragement to really hone in on numbers. So while there's a prejudice that lawyers don't do numbers, lawyers are smart. If we're smart, we can learn anything. It's just a matter of putting your mind to it. So, and currently I work in real estate. So I work with the Oniru royal family. So I have more or less spanned the gamut of investing. I worked in venture capital. I have been an entrepreneur, and now I'm working in real estate. When they say Oniru, people imagine money. I don't have money. But I know real estate. So yes, so that's been my work experience personally. So personally, I went into semi-retirement at the age of 26. I'm going to explain how I was able to do that, because I had, right from university, so I learned financial intelligence very early on. And I think that's how myself and Tosin got in touch, because we're basically on the same page. Now, Tosin is a very, very well-seasoned analyst. So, but she saw that I kind of had the passion for it too. So she helped me along the way, and So we've had points in time where we have differed in opinions on certain issues. I go my way, she goes her way, and that's for that. So I manage my personal portfolio, and in my spare time I write financial analysis reviews for banks and other organizations. So it's entirely a hobby thing, but it's a hobby that generates, well, a good return. So here's what I'm going to do for you very simply. One, I'm going to introduce you to the real world of wealth. Tosin has done a lot in that direction, but I'm going to touch it from certain angles. I'm going to introduce you to the real world of wealth. I'm going to differentiate between investing and speculating. I'm going to show you how to make money on the stock market from an introductory perspective, and I'm going to answer your questions. So that is my promise to you. And what I'm not going to do for you, I'm not going to ask you to invest with me. I'm not going to recommend any stocks to you or tell you what to buy or what I am buying. Because there's a fiduciary responsibility, or there's an ethical responsibility basically in investment, just the same way you have ethical responsibilities in our profession. So except you have an existing contractual relationship with the person, it's not ideal that you give any specific recommendations. So I'm not going to be doing that. I'm not going to make you a millionaire overnight or an investor overnight. Hopefully, I will get you started on that journey or getting closer to whatever goals you have set for yourself. Because investing, like I put there, is a lifelong journey. So what you're going to do for me is simple. Please, one, pay attention. Two, interrupt me at any time. But please let it be meaningful interruptions. And like I always, I have a lot of experience in facilitating, so I usually set this as my baseline for teaching. My baseline is the slowest learner. I'm not interested in the person who picks it the quickest. I'm interested in the person who is lagging behind because I want to carry everyone along. So let's get started. So the world of wealth. So let's discuss something, rich versus wealthy. Rich versus wealthy. I usually like to have an interactive class. Rich versus wealthy, what is wealth? Can anybody in their own personal terms, can anybody define wealth?
Too much money. Last time money.
Aha. So when you can be doing like this, when I say, you just say money not be problem. Aha, okay. So then what is rich? Huh?
You're just okay.
So it's a matter of degrees. When you're just okay, you're rich. But when there's aha, okay, so then you're wealthy. Okay, well that's an angle to it. So which do you prefer? Okay. Okay, let's put this into perspective. So in truth, there's no strict definition. There's no strict distinguishing between rich and wealthy because the terms, they overlap. It depends on the context in which you're using it. But for the sake of this discussion and for the sake of clearer thinking, right, the main difference between a rich person and a wealthy person is that a wealthy person has sustainable wealth. So it's sustainability. In other words, a wealthy person will always be wealthy, ceteris paribus, all things being equal. And whereas someone who is merely rich will only be so for a short time until the money is gone. Let's put that in context. Now, a person who earns, say, a person who wins the lottery for 20 million, right? Is that person rich or wealthy?
Rich.
A person who wins the lottery for 100 million, is that person rich or wealthy?
Rich.
A person who wins the lottery for 1 billion, is that person rich or wealthy?
Rich.
Okay. So then the idea of bastard money, as I said, doesn't capture the idea of being wealthy. Right? So wealth is about sustainability. So when a person has a lot of something, you basically say the person is rich. if you have a lot of clothes, you're rich in clothing, right? You have a lot of, so if a person has a high salary, for example, then that person is rich, you understand? But when a person is wealthy, now this is a different ball game. So wealth is a perpetual supply. That's really what wealth is about. Wealth is not just about quantity. Wealth is surplus on a consistent basis. That's what wealth is about. And that's what we hope most people are trying to achieve, because there's only, no matter how much you earn, there's only so much of your life you can spend working. That's one thing. That's why from the day you start working, you usually advise to start thinking about retirement, because there's going to be a point in time where you can no longer work. Now, aside from that, you have health issues which can sometimes incapacitate a person entirely. You have these stories of people who they were high flyers at some point in time, something went wrong. When whatever happened, then they went down to ground zero. You have stories like that all the time. Even our people who do like this, when one thing happens, one kind of problem comes out of nowhere, what happens? Then next day you see them selling off all their assets in order just to stay afloat. So there's the idealized version of wealth, right? Which actually just refers to being rich. So maybe somebody hits some big money. Yeah, you're rich, that's good. It's good for people to be rich. It's good for you to earn the maximum that you can earn given your working capacity, right? But thinking long term, you have to start thinking about wealth. All right, so for doing a specific task, maybe there's a contract, you perform the contract, you get a nice bonus or something like that. We're all lawyers here. When election season is around the corner, nobody's answering me. Election petition and things like that. It's a very common thing in law firms. Everybody's looking forward to that period because you know that bonuses, things like that, end of year bonuses, stuff like that. So that's all of that is active income. But the moment you go out of work, the moment you maybe fall into some ailment or some difficulty, right? What speaks at that point in time is the wealth that you have built up or the wealth that you have accumulated. So that's why it's a much more important thing for you to focus on wealth than to focus on just being rich. So you have to start thinking long term, start thinking along the lines of sustainability. So the real difference is passive income. And like we said here, the wealthy have passive income and thus they have more free time to live. Because what passive income is that passive income is income that is earned by not working, by not putting in hours. Passive income is income that you earn not directly from your labor, but from the labor of your money itself. So when your money starts working for you, and that's ultimately what wealth is about. It's about making your money work for you. So passive income is a financial term for freedom. Waking up every day with a little more money than you had yesterday. So now here's the thing about money. Let's talk about money. Now the natural direction of money is where? Is it forward, upward, or downward? The natural direction of money. If somebody gives you, so the natural direction of money is downward. When money is put anywhere, even if you put it inside your bank account, I'm sure Tosin must have touched on inflation and depreciation. So money goes down by default. But in order for you to structure yourself, structure your life in such a way that rather than going down, it's going up, and that takes some financial re-engineering. So you're thinking differently, you're setting things in order for it to start going upwards. So passive income basically is the term for financial freedom. The ability to wake up every day and have the resources to do the things you want to do. That's what wealth is about. It's not about buying into some socially constructed idea of having 20 cars and having whatever. It is the ability to do the things that you want to do. The freedom to go where you want to go. And now here's a commonly used statement. Most millionaires have at least 7 sources of income. Now that statement can be misleading, and a lot of people use it in the wrong context. So I just really wanted to disabuse the popular notion of that. Most millionaires have more than 7, or how many, whatever number it is that they peg it at. But many times people don't differentiate between if that is active income or passive income. Because the quickest way for you to run yourself aground is to have more than 2 jobs. So imagine you're having 7 jobs. That won't work. Now the reason why I say this is because in most cases when people are introducing the idea of passive income to you, they're usually trying to get you to buy into some product. True or false? They're usually trying to get you to buy into some pyramid or whatever it is, and basically they're actually giving you a job. The job that they're giving you is a very difficult job, and that job is marketing. When First Bank we send out whatever information that they're hiring marketers, people will be reluctant to go. They say, no, I don't want to do marketing. But when somebody says, oh, there's some passive income scheme or something like that, because they're using the term passive income, they're actually giving you marketing job under the term passive income. So a lot of people buy into that, they subscribe, and then 2 months later they realize, it's not as easy as they said it was. So they told us that we'll just put money here and then money will just be flowing like that. So that's the reason why I highlighted that. So this is often used in the wrong context. Passive income is strictly your money working for you. You don't do anything beyond brain power. So once you set the money in certain directions, then it begins to work for you. So we're going to do something here. So let's talk about numbers, right? Like I said, I'm introducing you to the world of wealth to kind of reorient your perspective towards wealth. So now you have different kinds of numbers, right? You have biometrics. Biometrics has to do with the numbers of our bodies, right? Your height is part of your biometrics, your blood count, your things like that. So all of those make up your biometrics. Your psychometrics, things like your IQ, your disposition and stuff like that. Your academic grades, etc. Now, but what about your econometrics? Your econometrics are the numbers of your life financially. And like I talked about, the financial re-engineering that is needed to take a person from that downward slope of money to an upward slope of money has to do with this econometrics, setting up your numbers properly. So we're going to do a simple exercise in that. All right, so this is going to be practical. Let's take out 2 minutes to do this. Do we have paper and pen? Okay, so please, you might have to cover your paper so that nobody can see, because this is money matter. So the instructions: take out the sheet of paper, write how much you have in savings. If you have 0, simply write 0. But we're trying to clean up the house and start making progress. So you can also state beside it how much is your monthly income, what percentage of that goes into savings, what you are currently putting your savings into. Are you saving for rent? Are you saving for a car? Are you saving to invest? So you can write them all out. And if you're saving, if you're investing in something, you can also identify what interest rate you are getting on your savings. And ultimately what we're going to is, what is your passive income? So we're taking a practical approach to this, so it's not theory. This is everyday life. So let's know where you're at right now. I want you to know where you're at so that you can start making progress. everybody done number 4? Okay, so can I change the page? Can I? Okay, so 10 seconds left. Alright, so I hope you've all done this. Now, the purpose of this exercise is that just the same way you know, let's say, your GPA in university, right? Just the same way you know your height, your blood group, your genotype, it's the same way you should have a very clear picture of where you're at. Because when you're trying to grow something, you have to know where you're starting from. You have to know exactly where you're at so you can calibrate your direction. All right, so here's an example. I'm not going to dwell on this, right? I'm just going to run through this very quickly. I use this to just draw a picture of passive income. Now, remember the point of this whole exercise is to identify this passive income. And what did we say passive income is? Passive income is income that is generated without your direct effort. It's your money that's actually working for you. All right, so now let's use this. Let's say Kunle, this person, Kunle did this exercise, right? Now Kunle starts off his career, he's 24 years old, he has 80,000 naira in his savings. Some people may have more than that, some people may have less than that. Let's just follow along. Now his monthly income is 200,000 naira, for instance. And every month he saves 20% of his income, that's 40,000. And he started saving 2 months ago. That's how he even got that first 80,000 in his savings. Now every month he puts his savings into treasury bills, for example, right? Which guarantees him 12% returns per annum. His monthly ROI, when you normalize those figures on a monthly basis, is 0.01%. Very unattractive. So while his saving is accumulating each month, his passive income is also growing little by little. Now let's look at how this happens. So in the first month he saved 40,000, second month he saved 80, he grew to 80, third month he grew to 120, fourth month he grew to 160, and by the ninth month he had 360,000 saved up. Alright? Now, as this income grew, now where did he start from? His passive income at just 0.01%, right? On a monthly basis. This is not 5% monthly. This is not 10% monthly. This is 0.01% on a monthly basis. He was getting just 400 naira. 400 naira in a month. Very terrible, right? What can 400 naira do for you? What can 400 naira do? Recharge card. Or and buying bags of pure water. 5 bags of pure water. That's a good idea. So at least with 400 naira you can buy 4 bags of pure water, right?
No. If you buy directly from the shop. All right. So in just 1 month, right? If he saved up that 40,000, the passive income from that 40,000 can buy him 4 bags of pure water in a month. So that has taken care of 4 bags of pure water for that month, right? Now after 10 months, what's happening? This passive income has gone from 400 naira to what? 3,600 naira. That's no longer 4 bags of pure water. What can 3,600 do? It's still with 1 kilo.
You're really into this. I like the fact that you're connecting with this. Because, okay, so 3,600 naira, depending on who you are, that can buy your data for the month, right? That can take your data depending on the network you use. You can, depending on the network you use. Okay, so now let's say he does this consistently for 5 years.
5 years. He just forms it as a habit. Whenever he gets his salary, he's not doing anything creative. He's not doing any magic. He's not even looking for any proactive investment. He's just buying treasury bills every month, right? Now in 5 months, he did this in 9 months. In 5 years, as a habit, he worked in this law firm, and he was there for 5 years, and they never increased his salary. He was earning just 200K. Kunle is now 29 years old. He has remained at the same salary level because Nigeria is hard. He and all his mates have been hit hard by the top economy. However, in 5 years, he has how much saved up? 2.4 million naira saved up. Keep in mind, his salary never went up beyond 200K. His passive income never went up beyond 1% per month. And now he gets 24,000 every month instead of just 3.6K. So it has gone from turkey and stew. 24,000, what can you do with 24,000 in a month? You can do a lot more, right? So what can you do with 24K every month? He can maybe never worry about groceries in his house. And keep in mind that this is perpetual. This is not for 2 weeks, for 3 weeks. This is perpetual. He never has to think about groceries. How much is a bag of rice?
18,000.
18,000. The way you're coming at me with the picture.
Nigerian bag. I run my house
I like that. So that means he basically can. Now remember, this is Kunle, who is a 29-year-old bachelor. No dependents, nobody else to think about except for himself. In 5 years, he has built up 2.4 million naira in savings. His groceries, 18,000 naira, is taken care of. He can buy a bag of rice every month. He can, maybe if he doesn't want to buy a bag of rice, he can pay for his gym subscription perpetually. He can maybe never worry about subscription again, data, Netflix, etc. That is for the rest of his life. Just by doing one simple thing, saving up that percentage of his income and letting the passive income flow. Remember, what are we talking about? We're talking about wealth, not being rich. We're talking about building wealth. So, now, like we said, Kule went from just having a salary of 200K monthly, right? Just that 200K salary. Went from just having 200K salary to having an active income of 200K every month, as long as he shows up to work. Having a stockpile of cash of 2.4 million naira, 12 times his monthly salary, which he can use to start a business or just watch it grow, and then a monthly passive income of 24,000 every month. Nothing changed. His salary did not increase. He did not increase the amount of returns that he was getting. This is all he did. In 50 years, if you were stuck at that same job, 50 years time, Kule would have a salary of 200K, but he would have a war chest of 240 million naira by the time of his retirement. And every month he will be receiving 240,000 naira, which should cover his living expenses if he never married, if nothing else happened. So that's just to give you an idea of passive income and what building wealth is about. Now, and this is the concept upon which your pension is built. So this is what pension is about. When you say, oh, your pension fund. So the pension fund, what they do is that because most people don't have the discipline to actually do this for themselves, so pension funds, what they do is that they pool people's funds and manage it for them. So we can go into a very lengthy discussion about that, but this is basically what they are doing. So if Kunle did it for himself, 50 years later, he would have 240 million from 200,000 naira salary. So the real secret to a lot of these things is just time. It's just time. Sorry, you wanted to ask? Okay. All right, so now let's take a parallel character. Let's take Shayo, right? Shayo started work at the same office with Kunle. They were both colleagues. Shayo didn't save any of his income. He expected a promotion that never came. Shayo, maybe some of us will relate to Shayo. Shayo borrows money and sometimes he runs into debt. Shayo believes that one day he will blow. So one day, one big contract. Now, after 5 years, Shayo is still in the same job, doing the same thing, and earning the same wage. Kunle and Shayo did were in the same job, doing the same thing, earning the same wage, but Kunle took a different approach. Shayo took a different approach. Kunle was strategical. He engineered his finances properly. Shayo just lived each day as it came. Shayo wants to go to Canada because he's frustrated now. Everything is hard. But he doesn't even have proof of funds, so he can't qualify. Kunle will qualify easily because he has built up 2.4 billion naira somewhere. So, but it gets worse. This isn't just where it stops. Now, 5 years later, Shayo accidentally finds a receipt belonging to Kunle showing 2.4 million naira. Inside this office that two of us are working. Don't I know Kunle? Shayo can't believe it. Both of them have the same job. How come Kunle has that kind of money? Evil thoughts start creeping into his mind. Maybe Kunle is stealing or doing Yahoo or doing something. Well. Now, Shayo feels pressure to do nefarious things in the office in order to catch up and get caught by EFCC, right? And he gets caught by EFCC. Or Shayo starts saving, and he wants to catch up with Kunle, so he starts making risky investments and falling for high interest scams and schemes. For every greedy person, there is a scammer waiting, and I put there, he that is greedy of gain troubles his own house. So there's a nice advert there that's just waiting for you. There are these things all over the place. There's something for everyone. Once you just decide that, I need to make this money fast, and something's waiting for you. All right, so the question is, how much does it really cost to be financially free? Now, we often think in large figures. We often think, oh, you need to have this 50 million naira contract. Maybe that's even a small figure for some people. Maybe you need to have this 200 million naira deal or $200 million, whatever. So, but let's get this very clear. The real cost is the cost of your freedom. How much is your living expenses in a month? How much is your rent? What percentage of your income goes to rent? What are your charges, living expenses, feeding, clothing, laundry, health insurance, transportation? If you have a source of income that covers all of that without having to go to an office, that is the meaning of the word financial freedom. That's simply what it means. It means that when you wake up in the morning, you can go and do exactly what you want to do, not what you have to do. Once you can cover all of this. So imagine if you woke up this morning and there was nothing chasing you. There was no debt chasing, there's no landlord chasing, there's absolutely nothing, car repairs, etc. It's something that's relatively easy to do if you put in the effort. So that's what this is about. So this is putting you in proper perspective. So there's a mathematical equation for solving that. There's something called a perpetuity. Right? I'm not going to go into the math because I can see some people's eyes are already like, man, don't try that. But nonetheless, basically, once you can determine this amount, which is very easy to do, you can sit down right now and go through your numbers and find out how much it costs, how much you're running at presently. In economics, they call it MPC, Marginal Propensity to Consume. So it's everything that you're currently doing. Everything you're currently doing stays within your salary. So if you were collecting your salary perpetually from another source, then you wouldn't need to work. So that is what financial freedom is about. That's what, when they say getting out of the rat race, you're no longer in that race of waking up in the morning, chasing clients, pursuing this, doing that. You can now do what you want to do. So that's the first part covered. So if you have that amount of money coming to you every day, every month, would you need to work again? Would you need to work again? The underlying word is need. You wouldn't need to work again. You would only do the things that you really want to do. So then you can pursue your passion, you can pursue things you're really interested in because you're not being buffeted by circumstances. So the concluding point here is that until you sort out these numbers, you're still in the rat race and you're living by the media definition of rich, which is an illusion. So they keep preaching is relationship between butterfly and caterpillar, or caterpillar and butterfly.
they are the same thing, but one metamorphoses into the other. So it is from income that you cut out a certain part, and that is what you're calling investment. So you're putting it into an investment plan. So a company is doing that for you, maybe ICO or Stanbic or something like that. That's savings that you have invested.
And when people say that if that's how money in the bank, apart from that, I don't know if I'm saying, apart from the investment,
Yeah.
and just savings like somewhere
Okay.
they have investment. I want to be sure is that.
I don't know what people are saying, but what I would say in that regard is that if you're putting your money into an investment program, right, there are usually terms and conditions, right? So those terms and conditions may constrict you in certain regards. So if you're doing something that has a fixed duration and you need cash that's more urgent than that fixed duration, then you can run into a jam. You understand? So that can happen.
If the terms are as flexible as almost the savings.
Basically, what you're doing is it's fine. It's fine. You shouldn't even carry money and keep it inside the bank for it to sit and be looking at you. There's a common saying: Wall Street, money never sleeps. So it's a crime for money to be sleeping. There's 1 million inside your bank account. What's it doing inside your bank account?
Like this scenario you gave, I'm
Yeah.
not sorry, I
No, it's fine. It's fine.
The scenario about the person has been working for like 2 years and he's been saving in his bank. So that's why I'm like, okay, is it until you have that money and be able to post? For example, you ask the question, how much you have invested? I wrote zero there. So is it, most people like to post and say like,
But
I have.
how much you have in it? But is there the investment program you're investing in, is there a stockpile, as it were? Is it growing?
Yes.
Then that's fine. So that's savings. It's savings, but they're giving you returns too.
Yes.
There was a certain media about people having several streams of income.
Yes.
The average lawyer
Yes.
has at least 4 streams of
That's
income.
wonderful.
I know because you are making money from real estate.
Yeah.
Those of us that do CAC,
Yeah.
hopefully people get into trouble, you get them out, you see those kind of stuff. So within that parameter, can I also query what you said about it's not possible for one person to have several streams of income?
No, I'm not sure I ever said it's not possible. I said you should understand how the appropriate use of that statement, right? It's not necessarily legal practice, but if you're going to set up an office, right? If you weren't doing that personally, you were setting up an office, this would be several services that you're offering. If you're going to hire lawyers and everybody was going to specialize, this person will be specializing in this, that. So those are multiple streams of income. But if you're doing all of that, all of those are still active income because you have to work at it. You understand? So, but as you're working at that, if you are sick, can you get up and go to CAC? You see how that works. So it's money that's going to come to you whether you're incapacitated or not. 1,000 naira, thank you. All right, so let's get moving for the sake of time. So now the second issue here is the difference between investing and speculating. And this is a very, very important subject because a lot of people, so we're going from, okay, you have formed the discipline of keeping a certain percentage of your income, right? Whatever money comes your way, you keep a certain percentage. Like we said, even if you're doing that with the barest minimum investment program, you over time are going to accumulate wealth. It's not a big deal. It's not wealth is a natural part of human existence. The way children grow, the way a person is small today and then you see them in 5 years time, you are big now. That's the same way you're supposed to have a bank account. You come back in 5 years time and see the account, you are big now. That's naturally what it's supposed to be. It is naturally what it's supposed to be. So the difference between investing and speculating. So like we said, so once you've been able to demarcate a certain portion of your income and you say, okay, you're going to put this into something, right? The question is of what you put it into. Are we together?
Yes.
Aha. So that's why we now enter into this whole subject matter. So let's take the definition of investing, because investing is a term that is used very loosely. So the definition of investing as postulated by Benjamin Graham.
I'll tell you who Benjamin Graham is in a moment. So, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. All operations not meeting these requirements are speculative. That's the most comprehensive definition of investing. And this definition was put forth by Benjamin Graham. Now, who was Benjamin Graham? Benjamin Graham was Warren Buffett's professor in the University of Columbia, if I'm not mistaken. He was the person who actually taught Warren Buffett how to invest. He was also Warren Buffett's mentor and his earliest employer. So immediately after Warren Buffett finished his, Warren Buffett actually went to University of Columbia to learn under Benjamin Graham. So, and after he graduated, he went to work for Benjamin Graham. So most of what he learned in investing, he learned it under Benjamin Graham. Warren Buffett himself has never published a book. There have been books written about him. So if you really want to learn how Warren Buffett invests, you should read Benjamin Graham. So, do we all know who Warren Buffett is? Is there anybody who doesn't know? Okay. Right. So, here are a few keywords. The keywords, I'd like us to all just read the definition again together so that it sticks. Can we all take it together? An investment operation is one which, upon thorough analysis, promises safety of principal and adequate return. All operations not meeting these requirements are speculative. Thank you very much. So the key words are this: thorough analysis. 2, safety of principal. And 3, adequate returns. Not stupendous returns, adequate returns. Not, if it turns out well, I will make a lot of money, but if it doesn't turn out, well, you win some, you lose some. No, that's not investing. And it is not, well, that's what's raining now. So, if there is no thorough analysis, you're not investing, you're speculating. If there is no safety of principal, you're not investing, you're speculating. If there's inadequate returns, or after you've done your maths, you are going to make a loss mathematically, you're not investing. I don't even know what you're doing at that point in time. So these are the key components of any investment. So let's look at this now. Which of these is an investment and which of these is speculation? So number 1, buying a piece of real estate based on the belief that land always appreciates. Is that investment or speculation? Speculation. If you buy, people who bought land in, yeah, you're entitled to an opinion. Sorry, this. So buying a piece of real estate based on the belief that land always appreciates. So the implication is, if this piece of land, I buy it 5 million, right? Then I now offer you that piece of land for 20 million. You will buy it for 20 million because land always appreciates. You will wait for 100 years for the land will appreciate. Because if all the land surrounding it is selling for 5 million, nobody's going to buy that your land for 20 million. So, in general, land typically appreciates over time. Typically. That's because the demand for land always usually goes upwards. But there are many cases where the value of land depreciates. A lot of cases. For example, anybody who has land in what's happening in the north, Boko Haram area, Sambisa. There are people who have, Sambisa doesn't have owner of land. People are selling their land and they're trying to get out of there. So things don't always go upwards. There has to be some analysis. If you pay too much for real estate, you are not going to enjoy appreciation of value. Sir, true or false? True. So there's no hard and fast rule that land always appreciates. You have to do an analysis. Now, is this an investment or speculation? Buying a rundown property in Bariga after evaluating the real estate market trends and realizing that the property is undervalued and would yield a good profit. That's an investment. I heard you saying something about that. Buying undervalued property. To the eyes of people outside, this rundown property, instead of you to go and buy one fine new house inside Lekki, you are coming to Bariga to come and look at dilapidated structures. But like he said, you come there, you do an analysis. Oh, students stay around here. Okay, so that's an indication of demand, right? So students will need a particular kind of housing. I'm not going to do 4-bedroom luxury flat here. No, I'm going to do single room for students to rent. You take that place, of course, because maybe it's in an area where nobody even wants to stay, but students are willing to stay. Somebody who owns the property and has left it over time, no longer even wants it, is willing to sell it for whatever price. You buy it at a cheap price, you develop that property, you start making how much returns? In 2 years, you're making a lot of profit from that property that is undervalued. That's an investment. You're not going to make that kind of profit because that's what people are doing. You're going to make that kind of profit because you did your homework. Thorough analysis. So, buying Merry-Bet's tickets because your friend won 2 million naira last week, and since Liverpool won their last 4 games, they will win their next match. That's pure speculation. Even if they won their last 100 games, there's a trick in mathematics. It's called the gambler's. There's a particular word for it. The gambler's folly or the gambler's trick. So, and it is that when a person goes to gamble, if they get 1, 2, 3 right, they have the tendency to assume that they're going to get the next one right because they got the last 3 right. But the probability remains the same that they're either going to get it right or wrong. So it's something in mathematics. Now, buying the shares of Dangote PLC because it's the biggest company in Nigeria. Not everybody is agreeing. Is that investment or speculation? Speculation. Why? Any analysis? No analysis. No research.
No specific return even at
So it's Dangote. And you would agree with me that when it comes to buying shares, unfortunately that's how a lot of people buy shares. Zenith Bank is selling shares. It's Zenith Bank. Dangote is doing an offering, public offering. It's Dangote. And then at the end of the day, when things go south, now wow, stock market, me, never. How will I ever put my money inside shares? That's how a lot of people buy shares. That's the problem. No analysis. So, buying the shares of Diamond Bank before the collapse because you had done your homework and found that the impending merger such as acquisition will be favorable to your interest. Investment or speculation? That's an investment. You did your homework. So, this is a very interesting debate. So, is Forex an investment or a speculation?
Speculation.
So, I want to ask that the fact that a company is big, like looking at down the table, like for example now, as Tosin was talking about stocks and shares, my mind was going into getting down the table stocks when it comes down, because I just think that the size of the company or the volume or what the company does should be like an indices or for you to go into investing in that company. Dangote is building a large refinery now. And so I just feel that there's something when we come up with that.
Okay, so if you remember, I made a side comment when we started. I said sometimes Tosi and I disagree on certain things. So Tosin is a market analyst, right? She's a market analyst. And when market analysts operate, what they do is that they look at the overall market as a whole. And when you look at the overall market as a whole, you're looking at both the bad and the good, and you're taking the aggregate. That's what market analysts do. So they look at the trend. Oh, is the stock exchange going upwards or going downwards? Those are general trends that they look at. Now, what I do is security analysis. And what that means is that I'm not looking at the entire market, I'm looking at Dangote. So, Tosin is looking at the market. I'm not looking at the market, I'm looking at Dangote. And if I'm looking at Dangote and I'm not satisfied based on that definition, what was the definition? Thorough analysis, what again? Safety of capital and adequate returns. If I'm not satisfied with those three things, no matter what they call you, because inside the very same investment where somebody will make 100% returns, the next person is going to lose. That's how the stock market is. You'll find out where as we go along. So the quality, the reputation, right, is what is called a qualitative factor. So in analysis, you have quantitative analysis and qualitative analysis. Quantitative analysis is numbers. You're comparing numbers, right? You're looking at, oh, this and this and this. Does this make numerical sense? So using the example of the property at Bariga that is run down, that's not a quality property, in quotes. The one that is at Lekki that is very fine and brand new, that would be a quality property. But if I do my homework like he says he does, if he does his homework, he will make profit inside that run-down property. While another person who doesn't do his homework will make a loss inside that property in Lekki. You see how this thing goes. So that's why we're talking about the difference between investment and speculation. So I asked the question, is Forex investment or speculation? What's your opinion? Speculation. Okay, anybody for investment?
That's the only thing that is guaranteed.
I read an interview of someone who runs a company that trains you how to do Forex and all. And before that interview, Forex was above my head. I know she spoke, but she talked about it's not one hit wonder. You have to follow through. You have to keep the tabs. You have to do your homework, like you said. So if you are, it depends on how you choose to do it.
Okay, so, okay, a different opinion.
I think, yes, the only thing that is sure about Forex from our definition is the thorough analysis. And that's just one thing you just do in one little corner. It doesn't guarantee that the market is safe. And it doesn't guarantee that the returns will come.
Neither do shares.
Okay, so that's why I brought it up for debate. We can debate and debate and debate. So the next slide is going to surprise you, but let's keep going. Now, for Forex, you have thorough analysis. You can do thorough analysis on Forex. Now, security of capital. With Forex. So that's where it has a speculative element. You understand? And you see the danger in that. So, and nothing here is to imply that speculation is entirely bad. But we are differentiating between investment and speculation. Because if you're speculating, you should know that you are speculating. And if you're investing, you should know that you're investing. All right, so here's what we're saying. It is possible to speculate in the same venture where another person is investing. So one person can be investing in Dangote, the next person is speculating with Dangote. One person can be investing in real estate, the next person can be speculating in real estate. So it's not just always the nature of the investment itself. It's also the nature of the way the person approaches it. Are we all together? Okay. So sometimes the line between investment and speculation is very thin. Speculations can pay out big. They can. And everyone loves a good speculation story. Crowds love speculation. But everyone who has ever been wrecked was more likely involved in speculation than in investing. anybody who has ever lost a significant amount of money in what is called, in quote, investing, was more likely engaged in speculation than in investing. So, and like I've said before, most people engage in speculation because they assume that the past equals the future, or that trends are perpetual. So there's a very strong psychological element that goes with speculation. And you see that a lot when certain things are trending. Once something is trending, it's not just a Nigerian phenomenon. It happens all across the world. As one person makes returns, the next person makes returns, the next person makes returns. Before you know what's happening, that thing is going viral. So everybody is jumping on that trend. They're jumping on that trend. They're jumping on that trend. They are all speculating because people are not per se doing their homework. They are only working on the basis of, this thing worked for this person. It is my turn, this thing is going to work for me. That happens with both the stock market, real estate, and whatever new fancy investment program, Forex, etc. comes along the way. Are we all following? So, now here's the thing. So, the pros and cons of speculation. Now, speculation, like we said, once it doesn't fit the definition of investment, it's speculation. And like I said, speculation is not all bad. You can make a speculation based on professional capacity. Because if you are looking at how something is going to turn out, right? Maybe there's a particular event that is happening and you have certain kind of information or you have certain expertise, you can actually make a lot of profit off of that because of the expertise that you have. I'm going to, if there's time, I'm going to share a personal incident that has to do with this. So a few big wins. So here are some notable stories of speculation. Now, like I said, speculation gets the news. Speculation is what makes news. And once something hits in speculation, a lot of people run after it. So this is George Soros. George Soros is the largest Forex trader in the world. He's an institutional trader. He runs the Soros Fund, etc. Now, he's nicknamed the man who broke the Bank of England because in one day he made £1 billion off the speculation. So, of course, he's not doing guesswork. Like you said, analysis. So he had been doing analysis and he had noticed that, there was an unsustainable trend in the pound at that point in time. So he started to bet against the pound. That's what's called going short. So he started to bet against that, that this thing was going to depreciate in value. So he started to buy other currencies so that when the pound drops in value, you convert it back to pound and you have more pounds. That's what it means when they say somebody is going short. When you're going long, is that you're expecting this thing to go upwards, so you're putting money inside it so that you will grow with the trend. And he did that, and there was a situation that was going on at that point in time and it had to do with some policy. And once that policy clicked, what happened? The pound regulated to its proper rate. So it dropped a certain percentage. And when it dropped that percentage, he converted his currency back and he made £1 billion in one day. It made headlines all over the world. So these are the kinds of stories that people love to hear. But these are stories of speculation. Bitcoin. I'm sure we've heard Bitcoin stories. How one person bought so amount of Bitcoin and then Bitcoin went to the moon. And people kept saying, it actually became a saying to the moon and all sorts of different things. So it was a craze too. So this also made headlines, 50 cents. In 2014, 50 cents, instead of selling his, I think his album, instead of selling it for US dollars, he allowed people to buy it in Bitcoin. The Bitcoin he kept inside an account and he just forgot about it. How many years later, Bitcoin skyrocketed in value and the money that was about, how much was it? $662 went to about $8 million. I mean, no. The total money was about $400,000 and it went up to about $8 million. So that is a stupendous return on investment. However, well, there are allegations that the story is actually not true. But this made news. I'm sure some of us saw it in the news when it happened. This is the kind of things that make news. It excites people. Oh, this person got 1,000. And once you have a speculative atmosphere, people are no longer thinking. Well, in this country, when MMM happened. So, you said? Zoom. So, once MMM happened, it created that speculative atmosphere. And once you have the speculative atmosphere, people are no longer doing the first thing, which is analysis. It's no analysis. The only analysis is that I've seen my alerts. That's the analysis. The only analysis for some people in the stock market is it has been going up since. The only analysis in Bitcoin is that it's going up. That's the analysis that they know. Somebody's Bitcoin of $1,000 has gone up to $2,000. That's the only analysis that they know. So when that happens, it creates a speculative atmosphere. People begin to speculate because everybody likes to jump on a speculation story. So unfortunately, there are also very big losses. And like we said, the biggest losses happen in speculation. A few notable crashes. Now, this is a very old incident. It's a classic case when you start studying stock market investing. It's a classic case, the South Sea bubble. Isaac Newton, the physicist. Isaac Newton, he was quoted as saying, "I can understand the movement of heavenly bodies, but I cannot understand the behavior of human beings." Because the South Sea bubble, it was a speculative situation where the value of the company shares had gone up and up and up. Now he had bought $7,000 worth of shares and he made a $7,000 profit on top of it. After he made that $7,000 profit, the thing was still going up. And for those who witnessed what happened during MMM, you carry 100,000 put inside, you make how much percent on top? You now start imagining, if I put. So I literally knew bankers who lost their job because of MMM, because they were actually using clients' money to do MMM. That's how bad it got. Because for God's sakes, where's the consequences? It's free money. So of course, by the time the whole thing blew up, the whole country, in Nigeria that doesn't have money, there was still money to lose. So speculation. You have the South Sea bubble. So these are even professional things. We're not even talking about MMM that's a questionable initiative on its own. We're talking about actual speculative scenarios. The South Sea bubble, the dot-com bubble, this happened around in the 90s when the internet first came up. So everybody believed that, internet businesses were going to be the new thing as long as it's on the internet. Whether it makes sense, whether the analysis makes any sense, no. Once it has .com in front of it, it's going to be big. Throw your money into it. That all went south. And then the Dutch tulip mania, that was a lot further back, very, very far back in history. But if you watch this movie, there's a movie where they refer to it, I think it's Wall Street, Money Never Sleeps. It's one of those movies. Wolf of Wall Street, or one of those Wall Street movies that they refer to it. Now, more recently, you had the stock market crash of 2008. That's the subprime mortgage crisis. Now, that was so bad that it almost threatened to collapse the whole world's financial system. The whole world. So in 2008, the US government had to bail out a couple of their major banks. Some major institutions went down because they had built an unsustainable system, which was on what's called subprime mortgages. So now, the whole investing is a very wide world. So really, you just pick the parts that you want to focus on. We can talk about so many different things. Anyway, so that's the point of this, is that speculation is that crazy swing. And when it's going upwards, it pulls in a lot of people with it. So the reason why the stock market as a whole is now in Nigeria is because the market trend has been downward. That's the simple reason why. It's not as though there's anything wrong with the companies. It's just that the market trend has been downwards. If the market trend were upward, as it were in 2006, 2007, 2008, people will be buying shares without doing their homework. That's the truth. So that's the psychological basis of speculation. So the psychological basis of speculation, the reason why speculation happens is for these reasons. One, you dream about the wins, but you actually are more likely to experience the losses. In every speculative scenario, you're thinking about the wins, once there's one or two instances where this thing has worked, you start fantasizing about the returns that you will get. But very often, the losses, because you didn't take into account the second part of the definition of investing, which is what? Safety of principal. As a rule of thumb, once you're doing any business online, that becomes your first point of concern. Because once you carry, there's something I tell people, there's arrestability, right? If I give somebody money, I want there to be somebody I can arrest. Arrestability. You cannot arrest the website.
Or an app.
Or an app. You cannot arrest app, you cannot arrest website. So as a rule of thumb, if something is online, you first have to satisfy that requirement of arrestability. Even if you're dealing with a physical person, that's why you have things like guarantor. It's that if everything goes wrong, who are you going to hold? Because you have to guarantee the safety of your principal. So people often dream about the big wins, but they are more likely to experience the losses. The recovery from a loss is twice as difficult. This is an important aspect of speculation. This is one thing that a lot of people don't take into consideration. If you lose 50% of your wealth, it doesn't take 50% profits to get it back. If you lose 50% of 100 naira, for example, 50% of 100 naira is what? 50 naira. So 100 minus 50 is what? 50 naira. So you now have 50 naira because you've lost 50 naira. You have 50 naira. Now, if you want to make back 50 naira, how many percent is that? It's 100%. You need to make the entire sum of money that you have back in order to just get to the original point that you started from. So losses cancel out gain in any speculative enterprise. That's why people who made money in whatever it is that they made money in, when losses come, especially if it's speculative, when the losses come, wipes out everything that they have been doing. So these are some of the dangers of speculation. Of course, most people are optimistic about the future. And another thing is that obvious prospects for physical growth in a business do not translate into obvious profits for investors. Now, this is an important point to the person who was talking about Dangote. So, obvious prospects for the growth of a business don't necessarily mean that it's going to be profitable to the investors. How? Now, if you're speculating, now let me use a practical example. Access Bank, Diamond Bank merger. Now, for those who are looking very closely at the facts, we know that it wasn't a merger, it was an acquisition. But they had to be crowd control because Access Bank did not want to be buying an empty shell. A bank is not the buildings, a bank is the customers. So if you send off shock waves into the market that, oh, this bank is in crisis, customers pull out their money. That's the first thing that they do. You understand? So what you're now going to be buying is just buildings. So if they had put out the news that they were acquiring Diamond Bank, the implication would have been that Diamond Bank was in crisis. But Diamond Bank, for those who were looking closely, was actually in crisis because they had about a 700 million naira, is it naira or dollars, euro bond debt that was hanging over them. And that debt was due in March. The previous year, I have the figures on my laptop, I can show you the figures. The previous year, Diamond Bank had made barely $1 million in profit, if I'm not mistaken. So the amount of money that they owed far outweighed the amount of the amount of money they were able to generate that year, and the debts were due. So if those debts had come due finally in March, right, then it would have been on headlines all over the country and all over the world that this bank was in crisis and can't pay its debts. So the smartest thing to do, and it so happened coincidentally that the amount of money that Diamond Bank was owing for the Eurobond was the amount of money that Access Bank had made the previous year in their profits. The exact same amount of money. So it was that, oh, if we take this amount of money and instead of sharing it as dividends to shareholders, we simply use it to pay off the Eurobond and structure a deal, right? Acquire Diamond Bank, pay off the Eurobonds. We solve everybody's problem. Everybody can walk away. That's basically what happened. Is it? Yeah. So and when that happened, of course, it's funny, if you were in that equation, if you were on the Diamond Bank part of the equation, you would actually have been walking away with a better return because it was a good deal. It was a good deal because previously Diamond Bank had been making losses, but Access Bank was going to buy out the shareholders if you wanted. So they gave them that option. If you wanted to walk away from the table, they will give you so amount per share and you could walk away. If you wanted to stay, very good, you now become a shareholder with Access Bank, the new institution, you understand? So now, Access Bank was acquiring all the assets of Diamond Bank, including its liabilities. In acquiring its assets and liabilities, that looks like a good thing, right? Because it is going to be a much bigger bank. But unfortunately, because of whatever factors, right, whatever factors were at play, the share price of Access Bank began to go down. That's what happened. So the share price of Access Bank kept going down and down and down until it went to, I don't remember the exact figures now, but they are my system there. So that's what happened. So what's the point I'm making? Obvious prospects for physical growth in a business do not translate into obvious profits for investors. So if you were going to speculate in that situation and say, oh, because Access Bank is acquiring Diamond Bank, right? So therefore, this would be a good buy at this point in time. And then you jump in on Access Bank. You haven't done your analysis properly. So you jump in on that situation, and it's ironic that if you're on the Diamond Bank side of the equation, you'd actually have had a better outing. But that's if you were speculating, like we said. So the fact that Dangote is building a new refinery, first of all, we do not know if it's going to be under, we don't know what legal entity is going to be under. I don't know if that has been published yet, if they're going to set up a new legal entity. So you might be buying into a different legal entity. Dangote has up to, there's Dangote Sugar, Dangote Flour, there's Dangote Cement, there's
Satellite and communication company.
I don't know if they are listed. I don't think they are listed. I'm talking about the companies that are listed. There's NASCOM. There's NASCOM. Dangote owns NASCOM, but it's not tied to the Dangote brand. So I think it's his wife that sits on the board there. So you see how these things happen. So I think they are the ones that make the tomatoes and other things. So it's not NASCOM. I forget the name of the company. So, but you don't know what entity that refinery is going to be under. So if you are buying, which of the Dangote are you going to buy? Are you going to buy Dangote Flour now? Or Dangote Cement? Which one? So please take note of that. So, but I want to restate this position, and I think I'm going to use an instance to really pass this across. Speculation is not entirely bad, but you have to be conscious when you are speculating. You have to know that, oh, this is speculation that you are doing. So, on speculation and why it persists. So here are a couple of quotes from Warren Buffett. And Warren Buffett says, a pin lies in wait for every bubble. If that's a financial bubble, when things are growing out of proportion. He says a pin lies in wait for every bubble. And when the bubble and the pin eventually meet, a new wave of investors learned some very old lessons. First, many in Wall Street, a community in which quality control is not prized, will sell investors anything that they are willing to buy. Second, speculation is most dangerous when it looks easiest. It's when the ovation is loudest. That's when the thing wants to hit you. Now, also it says the line separating investment and speculation, which is never as bright and clear, becomes blurred still further when most market participants have recently enjoyed triumphs. When you just made a nice profit, when the thing has been going well, that is when the line becomes very blurry. Nothing sedates rationality like large doses of effortless money. After a heady experience of that kind, normal, sensible people drift into a behavior akin to that of Cinderella at the ball. So you're dancing, you're walking on air. Aha. And now let me tell you where this is most rampant. If you've lost money in Forex, just raise your hand, let me see. Okay. Anybody else? This is a very common thing that happens to Forex traders. What happens to a lot of Forex traders is that if they make 1, 2, 3 consistent right decisions, then they assume or they conclude that they have come up with an infallible method. So on the confidence of that, this person now comes out to call on people to come and invest with him. And then he shows you a track record because he actually does have a track record, right? 1 or 2 or 3 good wins. And then the person begins to promise you guaranteed returns. Somebody's offering you 20% returns on Forex. Forex by nature is a volatile asset. How one is able to promise you fixed returns on a volatile asset is something that can only come out of an out of proportion amount of confidence. Because this thing can go up or down. But you are promising somebody that you are going to consistently going to give them profits. So that happened to me when I was in my 2nd year in university. A couple of friends, they got together, they said, oh, there's this guy who does Forex. I said, look, I have no interest in Forex or whatever. And they said, oh, no, the guy is good, is that. I said, okay. I'm not persuaded by it. I think, if for those of us who are on the Money Africa platform, like Tosin runs a platform on Facebook, I recently wrote about the experience. And so they said, oh, let's all do it together. And I said, look, I'm not persuaded, but because you guys are my friends, let me follow before I do. So yeah, I put in my small lot along with them, carried all the money, gave it to this guy. Carried money, gave it to this guy. So after we had given it to the guy, he was supposed to run it for 3 months, and after 3 months he would start paying us returns. So yeah, 3 months have passed. Returns, their returns start. First of all, the 30% that he had promised, he was now doing palliative. Just hold this small amount first. And just hold this 50K first. Just don't worry. Things are what? So the market is over. By the time 1 month, 2 months, 3 months are going into it, by the 2nd month we're now getting consistent stories. So it was no longer small returns, it was now stories. The market corrected itself, and there was no grammar when we were handing over the money. Now there's grammar in returns. So by about 6 months after, like 6 months from when we gave him the money, so 3 months waiting period, then 3 months further in, right? 6 months in, we now started hearing rumors that this guy was preparing to move to the UK. Interesting. Okay. So, and that time we're not smiling, 200 level, we are going black and white, we are law students, so we are going to show ourselves. So now we went to just want to use police to go and pick the guy. Currently, this whole thing ended up inside the police station. Police station, it was his brother that now had to come and stand at surety and start making payments. So the brother spent, of course, first of all, you know that whatever returns you're expecting is out of the window. Your work now is getting your capital, getting the capital back complete. That's after police, court, and other things, because you have to pay them service charges and other things. And then at the end of the day, it was 1 year later, exactly 1 year later, from the day that we first gave him the money, that we got the complete money back. And what was the conclusion of that? That the lesson for me of that was this: 1% profit and safety of principal is better than police station driving people. That was a lesson. So when people say, this investment, is just 2%. What is even 2%? Okay, maybe you prefer police and driving. So, in any case, so the point I was making was that people, especially in things like Forex, right, they get carried away, especially when they've had maybe consistent wins. So then they begin to imagine that they have a system or they have a method. So you should come and invest with them. Unfortunately, very recently, a similar situation happened. And this is somebody that I happen to know. So we had our differences. I have nothing to do with Forex. For who it may concern, you're free to go. I will give you my blessing. But because it doesn't fit that definition, I'm not going to speculate inside Forex. Even if I'm going to speculate at all, I'm going to speculate inside what I know, which is the stock market. So this guy collected loads of money from different people, and it went bust. He's a very well-known person on social media, and people started calling out this guy online from all over the world, and it was so bad. It was really bad. So, and at that point in time, I just thought to myself, reputation is a very important thing. You can't buy reputation inside markets. So, but it's falling for this kind of thinking. So that's it on speculation. So before we move to this, the world of investing, like I said, I wanted to show you where speculation can be useful, right? And I'm going to use this particular instance. This is a real life incident, and I want to narrate, on one hand, how securities analysis, understanding companies, how it kind of differs from market analysis. In this particular instance, I'm going to reference Tosin because we had a difference of opinion on this. Now, there was a particular company sometime last year. The company was being delisted, right? So they were voluntarily delisting their shares from the stock exchange. They were saying, oh, they no longer wanted to be on the stock exchange because the shares of the company had performed very badly. So the company itself was doing fine. The shares on the market were not. Please, if you don't understand anything, just raise your hand. I will break it down as much as I can. So, and however, this company, to me, looked quite like the Barriga rundown apartments, right? Let me use that as an analogy. Are we following?
Yes.
So it wasn't a Dangote, it wasn't a GT Bank, it wasn't a popular. If I mention the name of the company, most people here would not even have ever heard of it. It was a rundown company in terms of reputation, but it's a very good company in terms of their business. And so I looked at this company, I did my analysis, I went through the financials. This company actually was doing fine. Unfortunately, because they didn't have the reputation, they didn't have the market size, etc., they were not very popular on the stock market. And that's one thing that people don't understand about the stock market. The stock market is not, the stock market does not show you the actual value of things. What it shows you is the market value or the perceived value. So very often the shares on the stock market, the price of shares that you see on the stock market are very different, or sometimes may be different from the actual value of the company. So, and this creates very interesting opportunities for people if they know how to read these figures. So, in this particular incident, the company was being delisted, and I had taken a look at their figures, I had taken a look at all the facts, and I realized that there was an opportunity in there, right? So I'll pause that story there. I'll come back to it when we finish the next chapter. So this is the final chapter, the world of investing.
Sorry to take you back.
Yeah.
Maybe, I'm not going to quote you verbatim, but what you said about the profit being, the principal being secured,
Yes.
and making 1% on top of whatever it is, no matter how small. Is that almost a universal principle?
Universal in what sense, please?
In the sense that be it for any kind of investment you want to go into, be it maybe forex, maybe be whatever it is, can I use that? Can that be a guiding principle for any form of investment or can go into?
If small profits are better than losses,
Yes.
I would think so. If small profits are better than going through so much hassle just to recover your principal back.
Yes, we focus on the principal with nothing touching the principal at all.
Oh no, if nothing is touching the principal, then you met the second requirement of an investment, which is safety of principal, right? Then the third requirement is adequate returns. So then you determine what is adequate. You understand? So adequacy is now relative. So now we're now looking at the world of investing. So you understand what speculation is?
Yes.
I hope everybody understands what speculation is.
Yes.
So, like we said before, there's intelligent speculation, but the difference is that if you're speculating, you should know that you are speculating. So if you are exposed to risk, you know that you are exposed to risk. You're not telling yourself that, oh, this is a guaranteed return when it is not, because then you're just deceiving yourself or setting yourself up for disaster. So remember the definition. So this is a picture of Benjamin Graham, who was Warren Buffett's teacher, and he basically established what is called value investing. Value investing is a system of investing which has the best, over time it has yielded the best returns on investing and also guaranteed the safety of principal. So now a lot of people don't quite have a clear perspective of how profits in investing work. Now, in order for you to understand the world of investing, you have to kind of have a fair idea of how business works. Business, in the simplest term, is carrying on some activity in order to make profit, right? That's what business is. You're doing some activity in order to make profit. Now, when you want to invest, what you're doing is that you are taking your money, and instead of you doing the business activity, you are handing it over to an organization or some other people for them to use it based on their expertise and to share a percentage of whatever their earning is with you. That's what investing is about. So when you're going into an investment operation, then what you're doing is that you are analyzing the business, you're analyzing whatever it is that they're doing, whether it is such that can generate such returns, and then you're also making sure that, okay, in the worst case scenario, you can get your capital back. So that's a good rule of thumb that applies to any kind of investing. If someone tells you about, there's this one in agriculture, I think farm crowding or so. If someone tells you about farm crowding, the first thing is, okay, what are they doing? Analyze what they are doing. They are doing rice production. Okay, how much does a standard rice farm, how much is the profit margin of a standard rice farm, right? From the standard profit margin of a rice farm, you can have an idea that, oh, if they share this profit, then I can make certain percentage. Now the reason why I'm stating this is that you have farm crowding, for example, I'm kind of diving. Now you have farm crowding. Now, because there's farm crowding and they are giving maybe 12% returns on, or 14% returns on poultry, for instance, right? Now, some other company may now come up and say, oh, because of the success of farm crowding, right, we're now going to do our own. And then they now actually start propagating the idea, oh, this is what we are doing. And because that you have farm crowding that has been doing it, you'll see this other one, and this now looks like an alternative. But what are the guarantees when you're dealing with something like farm crowding? First of all, how do you know your principal is secure? So that's why they usually state it very clearly. Oh, they are insured by, what is it that insures them? Leadway insurance. So they at least guarantee your capital. They guarantee your principal. So that tells you, okay, this is safe. This other company is coming up with some nice, let's give it a name, Money Agric, right? Or Wealth Agric. Let's say a company comes up and they call themselves Wealth Agric. And they're showing you the same kind of concept as farm crowding. And you look at it, and where farm crowding is offering you 15% on poultry, this company says, oh, they are going to give you 21% on poultry. It's a better deal. Is it not? It's a better deal. 15%. Farm crowding. These people, you know how much they're even making? It's just 15% of that. See this one, they're now giving 21%. Okay, this one is not insured. This one, you don't know their registered office. You cannot see anything that they are dealing with. But because they are promising you higher returns, then you move over here. That's how problems happen. So that's why I'm reminding you of the definition. Upon thorough analysis, guarantees the safety of principal and adequate returns. Anything not meeting up to this definition is speculation. So now to reassert this, now you might be wondering why I'm going through all of this before talking about the stock market. The stock market is simply understanding big businesses. And once you understand small businesses, you can just extrapolate that and just go through the formalities of big businesses. Because the only difference between a private company and a public company is that one complies with CAMA, the second one complies with SEC. That's it. We're all lawyers here. Private company is not bound by SEC regulations. Public company is bound by SEC regulations. But in order for you to understand how big companies work, you first have to understand it from small companies. So the principles of investing, then you now apply the principles, and then you can do that. So Graham's first goal was never to make money, it was to avoid losing any. So keep that in mind as a rule of thumb. Now, Warren Buffett's first rule number one of investing. What's rule number one? Never lose money. Rule number two is what? That's the simple rule. Rule number one, never lose money. Rule number two, never forget rule number one. So how do you not lose money in something as volatile as the stock market? I'm going to explain all of that. So investing isn't about beating others at their game, it's about controlling yourself at your own game. So these are experts on value investing who are now telling you what stock market investing is actually about from a value standpoint. Remember, this is not speculation. This is not trying to follow a trend or trying to follow a crowd. Now, the stock investor is neither right or wrong because others agree or disagree with him. He is right because his facts and analysis are right. That's Benjamin Graham. People who invest make money for themselves. People who speculate make money for their brokers. Now, I really want to highlight on that point. Now, unfortunately, currently in the Nigerian scene, right? Because that the markets have been on a downward trend in general because of poor economic policies and things like that, there isn't a lot of hype about stock market investing. But for the most part, if you're watching TV or watching business channels, etc., there's usually a lot of encouragement. I think even on YouTube, there's this I think Binomo or something like that. There are so many things that are constantly advertising investments, right? And they show you how easy it is. There's one advert. This is how easy it is to, the person presses a button, and then the thing goes up, and then the person presses the button again, and then, oh, you just made $1,000, and then, very good. So, now, the reason why, in most countries, a lot of that is projected to people. It's constantly projected to people. And it kind of, what it does is that it inspires the gambling appetite, which is the tendency for people to say, oh, I can actually make it big doing this. The people who actually make consistent profits from that are the brokers. The brokers are the people who actually make the trade for you. That's what I mean is that there are people who handle the transactions. You want to buy, for every time you buy, they take a certain percentage. It's less than 1%, 0.01%, something like that. They take a percentage. Every time you buy, every time you sell, they take a percentage, they take a percentage. So whether you make loss, whether you make profit, they take a percentage. So they will always encourage you to trade. They will always encourage, they will push you, trade, you know how much you can be making, you know how much you can get from this, that. So you see a lot of these adverts, FX Pro, etc. So, of course, and it's their statutory right, you understand, because as intermediaries, that's where they make their profits. It's the commissions of every transaction. So they always encourage people to trade. So now, of course, the rule is buy cheap, sell high. Very easily quoted. Everybody quotes that rule. Is there anybody here that doesn't know that rule? Buy cheap, sell high. Buy when something is cheap, sell when it's dear. Everybody knows the rule, but it's the most difficult thing to follow. Why? Because of speculative tendency. When something is unpopular, nobody wants to look at it. Everybody is looking at Ibejuleki for land, for example. Nobody is looking at Mowe. I don't know if people are looking at Mowe. I don't know if people are looking at Badagry. You understand? Nobody is looking that way. Now, I'm not saying that, oh, what's the first rule? The first rule is what? Thorough analysis. You have to do analysis. But the point is that when a crowd is heading in a direction, the intelligent investor is usually the person who stops and says, hey, what are people not looking at? So when everybody is heading in one direction, when everybody is heading to Lekki, it might be the dilapidated structures around Akoka that might actually be able to yield you the best returns. All right, so like we said, buy cheap, sell high. The simplest rule to quote, but the most difficult to follow, because it goes against herd instinct to follow crowd. So following that rule, would it be the best time to invest in stocks or in shares when the market is high and when it is very popular, or when the market is low and it is very unpopular? When would be the ideal time to buy? When it's low and unpopular. So in truth, this time is actually the best time to be sitting down and looking at the shares and saying, what's happening here? Okay, what's happening? Is this thing undervalued? Zenith Bank that's supposed to be 50 naira per share is selling at 20 naira per share. Zenith Bank. First Bank right now is, First Bank share price should be somewhere in the 3 naira or 4 naira range. This time last year, First Bank was selling at about 9 naira. It has gone down to about 3 naira. Nobody wants to buy, right? Like I said, caveat, I'm not giving any stock recommendations. You understand? But this is the point in time where intelligent investors will be looking and saying, okay, given all these market indices and looking at these shares itself, is there something here that nobody is seeing? That's the intelligence behind thorough analysis. You're looking at what nobody else is looking at. So now here's the interesting thing. Once maybe our president comes up with some wonderful policy tomorrow, right? Or some new thing happens and it suddenly starts to stimulate the economy. All of a sudden, you're going to have a lot of capital that's going to be pushing into the capital markets. And those share prices will start increasing and increasing and increasing. When it has increased to a certain point, what will happen? People will now say, shares, so somebody just bought shares, how much? And it has tripled in value. Now, let me go and buy my own. And they go and buy. When people who, the intelligent investors, they have bought nonsense. So it happens all the time. So, and like you said, it's possible to make profit in the very same thing where the next person is making loss. Because where one person is speculating, right, and the other person is investing, the investor is going to make profit, speculator is going to make loss. Why? Thorough analysis, security of principal, adequate returns. So, and okay, so here's another quote from Warren Buffett. We simply attempt to be fearful when others are greedy, and to be greedy when others are fearful. So it is when everybody is looking away. That is the point at which the intelligent investors are looking closely and saying, okay, what's going on here? So risk comes from not knowing what you are doing. Common statements, oh, the stock market is risky. Whatever investment is risky. Well, some investments are genuinely risky in their nature because they are genuinely speculative in nature, right? Which means that your capital is not guaranteed, the returns is not guaranteed. If you are going to purchase Merryfest tickets, there's a prospect of a big win, right? There's a prospect of a big win. But the higher probability is that you're going to lose, your capital is going to be lost, and you're also not going to make any returns. That's the reality. So, the question of risk, I usually put it this way. Now, an adult with a knife and a child with a spoon, who is more likely to harm themselves? A baby with a spoon and an adult with a knife, who is more likely to harm themselves? Baby with a spoon. So it's not the object itself per se that's risky. It's the ability to use the object that's risky. If we're lawyers here, if somebody buys a property, right? They don't do proper search, they don't do their due diligence before buying the property. They don't go and register the property. They don't do anything, they just have maybe even an oral alleged transfer of title. And the person has receipt that he bought the property and there was no deed, nothing. The statement, land always appreciates in value. How does it apply in that situation? So the amount of ignorance that this person has in this particular investment, which is supposed to be safe, is going to nullify the safety of that investment. So that's the proper way to think about risk. Risk is really a question of how much you know about something. Now remember, there's a story I said I was going to tell you about, and I'm going to conclude with that story. So, here's a quote for you. The stock market is a device for transferring money from the impatient to the patient. Because while the impatient are speculating, they're trying to make big gains, they are making trades here and there, the patients, they're simply waiting for market factors, market forces to correct themselves. The patient, they might buy shares. There was a particular incident where Warren Buffett made $13 billion on a particular share. That was this was a Chinese oil company. He bought the shares of this Chinese oil company when nobody had any interest in what was going on in China. He looked at the facts, looked at the figures, and he realized that, whoa, this was a bargain. And then he went and then he bought the shares. And he left them, forgot about them. Several years later, what happened? Of course, China, being China, the government boosted the operations of this oil company, etc., etc., etc. The rest is history. And the shares of the company, they appreciated over almost 500 times in value. And his lot in that company simply appreciated in value. And at the end of the day, his profits were over 13 billion on one share. And of course, at that point in time, when he has made the profits, that's when all the news broadcasters will now come back. How did you do it? And he said one simple thing. He said, well, other people are reading, there's something you always say, other people read Playboy. I read annual reports. That's simply what he said. Other people are reading, what to be the Nigerian equivalent of Playboy? Maybe they are reading some gossip blog, or they are reading some, they are reading some random thing. Why some people are reading those random things? He is simply just reading the annual reports and actually analyzing companies. So there's really no big secrets to stock market investing. There's no special one kind of technique. Once you understand business, right? You understand small business, you understand medium-sized businesses, you apply that to large businesses, and then you begin to understand the particular nuances of large businesses by virtue of the trading aspect of it. That is the fact that you have a stock exchange, right? Then you can begin to make proper decisions on the stock market. So that's what I'm trying to do. I'm trying to demystify it for you. Now, a couple of other quotes. It says, rule number 1, never lose money. Rule number 2, never forget rule number 1. Price is what you pay, value is what you get. In the business world, the rear view mirror is always clearer than the windshield. That's a very important thing to think about. It's always easier to look back and say, oh, this and this happened. To look front and say what is going to happen, it's not possible. As at this time last week, nobody would have said that, oh, there was going to be some xenophobic attack in South Africa. You can't see it coming. So that is why you do not play the game with the prospect of making some profits. You play the game with the prospect of guaranteeing the safety of your capital. That's your yardstick. That's constantly what you're looking at. Now, another quote there, only buy something you'll be happy to hold if the market shuts down for 10 years. That's a very interesting thing. Now, I'm going to, I'll throw a little more light on this, and then, okay, that says put 10% of your cash in short-term government bonds and 90% in very low-cost S&P index funds. Well, that particular quote, that was given during a particular interview. So he was talking specifically about the S&P 500. The S&P 500 is an index, right? A Standard & Poor index of 500 companies. And generally in countries like America, when the economy is on an upward trend, right? For most people, because that the economy is on an upward trend, rather than trying to diversify, it's best that you just buy into the economy. I don't know if that makes any sense. If the economy is on an upward trend, you buy into the economy. You can't do that in Nigeria because the economy is perpetually, unfortunately, on a downward trend because the economic structure is not properly put in place. So it's in these climes that you hear market analysts say, oh, the market is not performing. But security analysts who are looking closely at the companies will be making profits while market analysts are complaining. So, so this is about compound interest, how his wealth, for example, grew over time. So Warren Buffett's wealth grew from $5,000 when he was 14 to over, how much is that there? $58.58 billion at the age of 83. And that's basically the picture that I showed you with the instance of Kunle and Shiles. Because over time, Albert Einstein was one who said compound interest is the eighth wonder of the world. Because leaving money to compound, it grows significantly on its own. Now, why the stock market? Why the stock market? So we're going to round off on this point. Okay. So why the stock market? Now, the reason why you should invest in the stock market, or why you should start looking at the stock market, is that the stock market is the capital of capital. The stock market is where the wealth of the world is stored. When you say Dangote is a billionaire,
where is that money? It's not inside an account somewhere. It's not sitting inside an account. It's not sitting down inside an investment fund somewhere. It's sitting down right there on the market. He's sitting down inside his company, or his company is listed on the market. Do we understand that? Now, that's how the wealth of the world is measured, by the capital market, the stock market, because it's the market where there's capital. Now, when you're listing a company, right, the procedure for listing a company, you're taking a company that is private. You want to take this company public. What is the reason for taking this company public? You want to have access to the capital market. What is the capital market? The capital market is where there is money. The money is just sitting down and is looking for how to move around. So you meet up with regulatory requirements, right? You have to have performed at a certain level for the past 3 years. I think the requirement is $1 million, either 300 million naira for the past 3 years. That your company has to have generated that scale of operations for 3 years consecutively. Then, of course, you now start going through all the SEC compliances, Federal High Court, etc., and then you get listed. When you get listed, then your your underwriters, they will now help you take the thing to the public. When you take it to the public, people will now come and subscribe. When they subscribe, what are you saying? You are saying, oh, you want to raise 50 billion to improve your operations. Where is 50 billion going to come out from? It's not somebody's pocket. Capital markets. That's where the wealth of a nation is. That's apart from, of course, government coffers. So it comes out from capital markets, goes into private companies, and then they begin to use that capital to operate. So the relevance of that is that if you are running a private business, right, the goal of your private business, or a yardstick that you should be envisioning, is the point at which you can grow your company into becoming a publicly traded company. That is, you have met the requirements of being able to operate at a certain scale, such that the regulatory authorities will allow you access capital from the general public, which means, oh, you are trustworthy, you are capable of handling this amount of capital. So that's just in passing. Now, the stock market, of course, is the center of the world's economy. The stock market is the home of every long-term investor, and stocks are ironically the most flexible investment instrument in the world. Like I put there, what other investments can you actually make with 200 naira? You can buy shares of Cadbury for 200 naira. You can buy, if you want, there was a particular year, I wanted to attend mobile AGM because I was doing some research at the time. So I wanted to just know what was going on. And AGMs are only open to shareholders. And what did I do? I looked how much is mobile selling shares, 250 naira at the time. I carried 250 naira, bought one share. Am I not a shareholder? I carried my share. I went sat outside the meeting. Mr. Chairman, no. I had voting rights. I'm a shareholder. I attended the meeting. What it was this takeaway pack. The takeaway pack that I collected from the event was worth more than the shares that I bought. Well, that's just in passing. I hear they've actually, I think SEC has banned companies from sharing things during their AGMs because, well, that happens. So here's how money is made on the stock market. So this is the juicy part. Here's how money is made in the stock market in simple terms. 1, capital gains. What does that mean? It means that, you bought, any company, I'm tired of using that to you bought Nestle, exactly. So you bought Nestle shares. Nestle shares, well, maybe you bought it at 1,200, but that's where it usually hangs around. So you bought Nestle shares at that price, right? Nestle, after 1 year, they announced that, they have made so amount of profit. And what is due to each shareholder is so amount, right? Now, a company can choose to
pay out its entire profits to shareholders as dividends, or they can reserve some. The part that they reserve, it goes back into the books of the company, and it increases the value of the company. That's the actual value of the company, not the market value of the company. Do we get that? Okay. So, now let me differentiate something for you. Let me differentiate the stock market from a company. The difference between the stock market and a company. Now, let's say everybody here, right, is a company. Are we together? Everybody sitting here is a company. So choose whatever company you want to choose. Tell me, which company are you? You are Wando. I wouldn't recommend Wando. Okay. Okay, we really had a conversation about that, I think. Okay, so you are Wando, you are GTB, you are Nestle, okay, somebody there is Cadbury. So here we are the people who want to invest, right? We look at Wando, we look at GTB, we look at Nestle, we look at Cadbury, right? Now, Wando has its operations. It's doing its business. Its business must statutorily be reported every year. They must file annual reports, file annual returns, right? So the business has to be accounted for. So an auditor is going to audit the business and is going to publish it that, oh, this is how the business has fared this year, right? Every single one of them is going to do it. So that's what it means to be a public company. Your information is public. You are accounting to the public. See all the money that we made. See how we spent it. See how the money was used. This, that, and the information is public. An auditor signs on it, either KPMG or Deloitte or one of them, and says, this is, we have put our stamp and seal that these facts and figures are accurate. That's actually what went on inside the business. Are we following?
Yes.
That's actually what went on. Now, however, so that's the businesses themselves. Now, there's a second aspect to it, right? The second aspect is that there is a market. The market is, while there are these businesses, there are now these people who are buying the shares of these businesses. Are we following?
Yeah.
Now, you bought Cadbury, right? You bought Cadbury. Cadbury is the lady at the back. So you bought Cadbury, right? Now, if I want to buy Cadbury from you, right? Maybe you bought Cadbury at 200 naira, and I want to buy Cadbury from you. You can decide to sell it to me or not to sell it to me, right? That's where you now have the exchange, stock exchange. That's where the buying and selling goes on. It has nothing to do with the value of these businesses. It is just the exchange that we're exchanging amongst ourselves. So you bought Cadbury. I said her Cadbury at 20 naira. I said 50 naira. She has made a profit. So she now agrees to sell her Cadbury to me at 195 naira. I now pay 195 naira. I now have Cadbury. She made how much profit? Plenty of profit. For her, the price of Cadbury on the market, what will happen is that it will now record that, oh, Cadbury traded at 195 that day. Are you following?
Yes.
What happened? Did anything happen inside Cadbury itself?
No.
Nothing happened inside Cadbury. What happened was between us. But what will happen is that if somebody here was speculating, they'll say, Cadbury is going down. Cadbury office is still there. We drank Bonvita this morning. I'm sure it's Cadbury that makes Bonvita.
Yes.
We drank Bonvita this morning. Nothing happened to Cadbury. But because we exchanged it at a lower price, right? So this exchange here, like I was explaining, is what market analysts like Tosin and other analysts, that's what they look at. They look at the exchanges going on. You understand? If Buhari just brings out one news now that, from now on, cocoa is going to be the main export of Nigeria, right? All of a sudden, she will come back, and that Cadbury that I sold to you, after I bring the Cadbury, are we following? Then, me, I bought it at 195. What is that? You have to pay more. Then, she will now come and now buy the Cadbury from me at a higher price. This other person, she is waiting for the price to either go up, right? Or to at least get back to our original position, because now she's scared. So she wants it to get back to our original position so she can sell off. She doesn't really know what's happening. She just wants to make sure that her position is secure. So that is the difference. That's the element that companies on the stock exchange have that other companies don't have. Because when you're dealing with private companies, right, all you have is just this, the companies themselves. But once you have a company that is listed on the stock exchange, then you now have this element of it. And then this exchange that's going on, right? You can either be looking at this market as a whole and trying to follow it, or be looking at that company, doing your analysis, and then you now decide how you're going to approach these people. Does that make sense?
Yes.
Okay, so that is basically how it works. So how money is made on the stock market? So we're running for time now. How money is made on the stock market? One, capital gains, right? And what that means is that at the end of every year, when there's profit, right? When Cadbury makes profit, the amount they are going to share some money to their shareholders every year, right? If they make profit. That's what's called dividends. So whether the value of the company is going up or down, if they make profit, they're going to make dividends. So there are companies that are going down like this inside the market. Shareholders are still making their dividends at the end of the day. But people who don't understand the market, they are looking at it and saying, no, all these companies, they are losing money. Nothing is happening. The value of the exchange is just going down. That's all. And when it's going down like that, that's even the best time for you to be looking to see what can I get cheap. All right. So the ways money is made on the stock market, capital gains, which is the appreciation, speculation. If you make an intelligent speculation, you can actually make some money. Dividends is what you get every year. And then, of course, the stock exchange has the widest array of financial instruments, things like preference shares, futures, etc. They're just simply different classes of arrangements, debentures, etc., where investors make profits that are either agreed. So ordinary shares, you buy into either the profit or the loss of the business. Or in preference shares, then there's a fixed arrangement. This is what you're going to get irrespective of the profit that the company makes or the loss. Okay, of course, how money is lost on the stock market. Speculation is also how money is lost on the stock market. Buying the right company at the wrong price. If we understood this analogy, then we understand how that can happen.
Yeah.
Buying the right company, wrong price. Paying too high in fees, because there's the middleman that collects money for every transaction. So then by the time you are now putting money inside a particular fund and then there are fees involved, then that can also eat into the profits you're supposed to be earning. Following crowds, of course, and then not understanding what you're doing. So why the stock market is difficult to understand for most people, the terminologies is difficult. But the terminology, if you understand this, right, then it just takes time for you to understand the terminology. Once you get used to the terminology, then it's something you can't learn. Of course, the stock market is systematized, so there are rules inside the exchange. So you can't bid too low, you can't bid too high, you have to follow the rules. There are many players and many techniques, so it can be confusing. There are many stories, many charlatans, and genuine market collapses do happen because when these people, when they have carried the market, when we have traded too far, and it's too far from the reality over there, then this market is going to collapse because it's not sustainable. Somebody's going to burst the bubble. And then when it collapses, it has to go back to either that value or it's going to go lower. And that's when you see the market crash. But the companies are still there. Zenith Bank shares crash. Zenith Bank is still there. Okay. So on that note, please, how to get started. Remember what an investment is. Thorough analysis, safety of principal, provide adequate returns. I would like to do a practical demonstration, but there's no time at this point in time. So for now, so you need a specific bank account to buy shares. It's called a CSCS account, right? So if you have a broker, you can get a broker online and start buying shares. So you actually, the CSCS account is just like your bank account. You just have to go through the KYC process. It's like opening a bank account. So if you need an online broker, well, you can follow my Instagram page, One Nigerian Shareholder. I have a page on Instagram where I discuss shares and stuff. Not very active, I limit my social media use nowadays. But you can follow my page, and there's a link on my page that takes you to a broker, an online broker that's Investment One. They used to be part of GT Bank, but they're now independent. So you can get started and open a CSCS account. And once you have that account with your online brokers, then you can start buying shares. You can move your existing shares there. So I don't know if we'll have time for questions. So
maybe we can commence our questions and we'll send it to him. Yes, I think that's what we'll do. We have to leave here 6.
All right.
So guys, please.
Pardon me for mismanaging the time, but so far so good. I hope I have been able to make some sense out of this document. So in conclusion, please remember that life is more than money. The true joys in life are achieved good friendship, spending time with loved ones, good health, meaningful work, and contributing to society. You can have a very full, meaningful life when you do the things that are meaningful to you, and you are surrounded by people you love. $1 million is just a nice bonus. Thank you very much.
Thank you so very much.